Hello and welcome. In this presentation, we will discuss activity-based costing and how it can help improve the quality of cost information. We'll take the example of Senac, a Belgian company that supplies a full product package that includes seeds, products for plant nutrition and protection and supplies, as well as expert advice for agriculture and horticulture customers. Senac Home and Garden sector provides a full assortment of products to amateur gardeners, which include plant protection products, fertilizers, potting soil, and supplies. So they have different types of customer segments: agriculture, horticulture, and home and garden. In 2005, we know their business performance as well as some of their current product portfolio. Their revenues have been 62 million euros. We have line items 290,000, 7,000 products, 7,000 customers, 25 truck transportation fleet, 22,500 pallet warehouse, 129 employees, out of them 57 are in logistics, 40 sales technicians. And annual growth rate has been 10% from 1996 to 2005. Now, the sales in 1990s and 1990s were quite good, and there was little concern over relative profitability of customers. But in 2000s, things have changed. Market has become much more competitive. Margins have come down, and there's a fast changing market forces in play. Seasonal fluctuations have increased in terms of the activities that they have to do. There is higher business complexity, large diversity in products and customers, as well as large diversity in cost consumption by various cost objects. These cost objects could be business units, products, customers, etc. So they are interested in profitability enhancing strategy by looking at what the profitability is by their business units or customers or products. Currently, their understanding about contribution margin by sector is that home and garden has the highest gross margin, 24%, followed by horticulture with 20% and agriculture with 17%. And sales growth also is quite high in home and garden with 20%, horticulture with 10%, and agriculture with 3%. They did not include 2.5 million euros in fixed but increasing costs that are associated with processing an order, receiving incoming materials, picking an order or customer deliveries while calculating this gross margins and sales growth. Now, in accounting system, many of these so-called fixed costs are embedded within salaries and wages, depreciation, electricity expenses, sales, general, and administrative expenses. Now, Senac knew that something was not quite right about the profitability numbers that are reported by the accounting system, and they were trying to explore what was not correct. They also knew that their customers were quite different from each other. Their 20% of the most profitable customers generated 180% of profits, but much of this extra profits was being lost by serving these 20% least profitable customers. Right? So that's something which they were aware of. And they wanted to see what is going on with their current traditional costing system, which is not allowing them to create these profitability enhancing strategy focused by customers. Now, currently their traditional costing system is hiding some bit of profits and costs per customers, because what it does is it looks at customer A, customer B, and creates an assessment of their apparent profits, which might be not accounting for some of the additional costs that might exist for some customers and thereby reducing their profits. And it may have overestimated costs for some other customers and thereby underestimating the profits we're receiving from these customers. Now, to be able to find these hidden costs and hidden profits, we'll have to think about activity-based costing as against traditional costing as a way to get a better understanding of what's going on. Now, their accounting system typically looks at their sales figures, subtract product direct cost, subtract the overhead costs to get their gross profit margin, as we see here. Now, these are the costs, and the accountants report these by each product or customer. But in reality, they don't really know these overhead costs per customers, per products. Therefore, the assessment of this gross profit margins is not necessarily correct, because they don't necessarily have visibility on costs associated with selling, distribution, marketing, administrative. If we start adding these costs and subtract it from the gross profit margin, we might end up seeing a very different picture of that customer or product in terms of profitability. Now, because they don't have understanding of these costs, they are, in essence, distributing their costs to each customer in what they call a peanut buttering technique, basically spreading it across all customers equally without considering the diversity of these customers. Now, that's a challenge which we need to consider and take into account when we are rethinking the costing. The way this peanut buttering is happening is by looking at each customer in terms of their volume-based drivers like sales revenue, headcount, total direct cost, labor cost, etc. So even though there is some distribution of cost across these customers by using some volume-based drivers, it doesn't account for unique nature of these customers with respect to what exactly has to be done with home and garden versus horticulture versus agriculture. And by not accounting for that, it ends up creating an estimate of profit margins, which may not necessarily be the right representation. So the big question about cost is, why is the organization spending money on indirect resources that are the overhead? We need to ask this question to be able to really understand how these costs might be distributed across customers. How much is the organization spending on each of its activities? Why is the organization performing these activities for specific customers or for specific products? How much of each activity is required for the organization's products, services, and customers? And finally, how do we pool these costs? It's very important. So all these questions need to be answered. And we'll take an example of activity-based costing in subsequent discussion to see how we can change the way we look at the cost structure and have a better understanding of the profit margins based on products or customers or whichever cost pool we are looking at. Thank you.